Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide divorce valuation and mediation services in St. Louis, Missouri. Today, we will discuss active and passive appreciation of separate property in divorce with the esteemed Dr. Ashok Abbott, who is an associate professor of finance at West Virginia University. He is the founder of Business Valuation, Inc., where he provides value by determining statistical significance, validating economic models, and providing rigorous empirical analytical support. So basically, just a super expert at research and all things valuation. You talked about a couple cases, but do you have any past cases where separating the marital assets were just like almost impossible or completely difficult?
Until you go in and start digging. That's the important part. Remember, the market forces are something which are very prevalent. No business occurs in a vacuum. We are not in space. Okay.
Yeah,
so
right.
Everything is happening right here. So that is why it's very important to go back and dig. What is it that drives this particular market?
Mm-hmm.
What is it that drives this particular product? Now, see, one of the most interesting things that I came across was it was a chain of shoe stores, and it was a very unique concept. What they did was they would go to Italy, look at the very high-end shoes. You're looking at $3,000, $4,000 a pair kind of shoes. Put them in a suitcase, take them to China, and have the people there make something which was very close but not exact.
Mm-hmm.
So they had people that would be looking at, like, the shape of the buckle is patented, or that particular cut where it starts moving up from the mid step is patented. The sole has a certain tread that's patented. So they would have people analyze that shoe and then make an almost replica, but not something that could be seen as an infringement of the patents.
Mm-hmm.
Okay. So, and then they were selling these shoes. You know, all they started in Florida, but then they expanded all over the East Coast. Okay. Interesting thing. If you looked at just the population and the income and all, there wasn't much relationship. But when you started digging, actually that's what happens. You sit down with the owners and you say, who buys your shoes? Where do you sell them? What is the group? And then what we found was, after about a week of talking to their managers up and down the line, even going to some of the stores and sitting there in the background, seeing who is coming in and buying those shoes, what we found was that these were young women between 15 and 24 that were their prime customers. Okay. So when you look at the demographics of that particular ethnic group, that particular age group, it corresponded to that growth about 70%. So the change in this ethnic demographic group was driving their success beyond anything else. Of course, it was a well-run business, but if they did not have these customers, they would not have the market. Right. Older people were not buying them, because older people, if they could afford, they would buy the real shoes.
Right.
And these the tween market, these were kids that would not have the kind of money to buy that kind of a shoe, but they would very much want to be. That was an aspirational shoe for them.
Right.
So when you did that,
their friends are never going to figure it out, so they're okay with it.
that's what happens. So they can go out and be wearing those shoes, and everyone is looking and doing ooh and ah, and they're happy. And we found that that was, again, another factor that came out important was most of them did not have money even to buy these replicas in that sense. So a lot of them were essentially running on credit. So the credit card interest rates became another important determinant. And then the employment level in the 15 to 24-year age group in that region again became a determinant. So by the time you were done with these passive factors, close to 68, 69% of the growth was coming from these identifiable, quantifiable, specific factors.
Yeah, I think it's fascinating. If I kind of wrap it up in how I looked at it differently was after, talking to you and looking at the research, I think that normally we just tend to go to the business owner and we tend to say, okay, how can we quantify how their effort has created value? And this is really doing it differently and saying, okay, can you look at the passive side and say,
Right.
what were all of these factors in the market, in the industry for this particular company, locally, all of it that is more tangible, at least in our world, like it's more quantifiable
Right.
because there's statistical basis
Tests.
for some of
Tests.
it, right?
Under Daubert, basically, you have to have your analysis. Is this something that has been done before? Is this accepted? Is there a known rate of error? That's the critical point that comes in. Can you quantify how likely are you to not to be wrong? So if you say, I can be 90% certain that within this narrow band is the total amount of passive appreciation, or I'm 95% certain, or I'm 75% certain, depends. I mean, obviously your cone keeps getting wider as your certainty level starts getting narrower and narrower.
Right.
Okay. So what is acceptable? That's again the court's decision. So you give them that cone. Say, if you want 75% certainty, more likely than not, then this is the minimum, this is the maximum. If you want absolute, like 99% certainty, then this is the minimum and this is the maximum.